There is large cap, mid cap, and small cap. There is also a Bhangar cap, and more than 4,000 out of 6,000 listed companies fit into this category. They show up only in the good times. Be careful. These are the words of the famous Indian investor Vijay Kedia, also known as Market Master. He is a man who has spotted 100 baggers and many multi-baggers, meaning the stock of these companies have gone up 100 times or many times over. I think this is the most relevant quote in the present context. Hi guys, it's me Vedant, and in this video we're going to discuss about small cap, mid cap and large cap. And at the end, I will show a very interesting article that I came across in the Economic Times that is the best explanation I could find of why small and mid caps have performed exceedingly well in the past 1 year. These categories have been made based on market capitalization or market value of the company. This is the amount that you would have to pay to essentially purchase the entire company. As per SEBI, the regulator, the top 100 companies by market capitalization come under large cap. After that, from the 101st to the 251st company, the next 150 companies come under mid cap, and the ones that come after that, all of them come under small cap. Broadly speaking, I'm going to be looking at each of these categories with the following parameters: risk, volatility, growth potential, and liquidity of the stock. So let's begin with large cap. Well, as mentioned before, these are the 100 largest companies and often are extremely stable and market leaders in their respective segments. They are also commonly termed as blue chip companies. So let's begin with large cap. As mentioned before, these are the 100 largest companies and they are well established and relatively stable. They are often market leaders in their respective industries and are tracked very closely by financial institutions and brokerage firms. In terms of volatility, these companies' stocks have relatively low volatility. They tend to be more stable, and the liquidity of these stocks is also very high as they are very actively traded. In terms of risk, these companies run a very low chance of going bankrupt or failing compared to the peers who are of smaller capitalizations. In terms of growth potential, these companies cannot rapidly expand as small companies can. This is because these companies have already become massive. So now let's come to mid cap. As mentioned earlier, these are companies that come between the 101st and 251st position. These are still fairly large companies considering their market capitalization is usually upwards of 10,000 crores. And their growth usually depends on the domestic economy. These companies have a healthy liquidity in their stock as even these are actively traded, and they have a relatively more volatile stock compared to the large cap. These companies have a moderate risk compared to large cap as well. In terms of growth potential, they do have a good and healthy room for growth as these companies can still go on to become large cap companies and progress. So let's get on to the hottest segment, the small cap. These typically include companies that have a market capitalization of under 10,000 crores. These are newer and younger companies and are often not as closely tracked by brokerage firms and public or even financial institutions. These companies are usually the smaller players in their respective industries, and the growth of these companies depends tremendously on the governance ability of the management and promoters. And therefore, we must make sure that the promoters and the management are competent and most importantly ethical. By ethical, we mean they have not indulged in any financial scam or malpractice and have no criminal charges against them. The stocks of these companies are usually much more volatile and also not as liquid as they are not tracked so much by the public and others. So now I will show you the article I was talking about at the beginning. That article explained why mid and small caps performed exceedingly well in the past 1 year. We were recently dwelling on this very interesting dichotomy that we have witnessed in the Indian stock market in the last 15 months or so. The conventional wisdom prevailing last year in the first quarter was that the GST was going to drive out the unorganized sectors and all the business would flow into the arms of the organized sectors. And then the pandemic came. And this oversimplified opinion turned into a snowball, with everybody saying that the pandemic would accelerate the demise of the small guy and small companies and would accelerate the market share gains of the large guys. And therefore, the only game in town was to stick to comfort of the large caps and avoid smaller companies or the small caps. So keep buying HDFC Bank, HUL, Asian Paints, and you will keep singing all the way to the bank. Unfortunately, markets have a very irritating habit, even unfair, of destroying semi-baked and yet highly rigid opinions. So surprise, surprise, the best performing index in the world in calendar 2021 is the BSE Small Cap Index, up nearly 45%, and the Nifty 50, in which the alleged market share gainers are tightly clustered in, has delivered a princely 12% year to date and ranks at a lowly number 19, just ahead of Italy. Therefore, when we talk about a bull market in India, do remember that it is tightly focused on the mid and small cap end of the market, while the large caps have largely been somnolent. The reason for this is very straightforward. Large caps need a broad economic momentum to deliver growth on their already large basis. And so far, the data does not tell us that the larger, wider economy has recovered from the effect of the pandemic and even the recent lockdowns. Small cap companies operate in niche areas of the market and they can thrive in periods of relatively low growth because even a small order or a small contract or a small new business line can markedly alter their growth outlook. This is exactly what has happened in India in the last several months. The key question is what now? I go back to our proprietary model, the lake of returns theory, LORT, to predict equity returns. Each market, each asset class has a finite amount of return potential based on its long-term return characteristics. It is like the capacity of a lake or a reservoir. A lake can hold only a finite amount of water. When the levels of returns in any asset reach extremely low levels relative to its long-term returns, it becomes time for it to start filling up. And then the return level keeps rising till it reaches overflow levels, which basically means that the return levels of this particular asset class has overshot its capacity or long-term trend, and then the water floods over and causes massive devastation through a bear market. The returns from Indian small caps had reached the bottom of the lake because of the bear market that came in 2018-19 and part of 2020. The water level started to fill up only from this year in some momentum. They have reached a certain level wherein small intermediate overflow is possible, which basically in market terms means a breather. Some data is important. Typically, small caps globally return around 30 to 50% more than large caps. Indian large caps have returned around 15% CAGR over several decades. Indian small caps since the start of their index have returned around 10% to date. From January 2008 till now, they have returned just 5% CAGR, well below their own capacity of 10% annual returns. The data is clear. Indian small caps, while set for a small short-term overflow given recent strong gains, still have plenty of headroom capacity left in their lake before a grand devastating overflow happens. Investors should take some gains off the table, remain diversified over at least 25 stocks, not be concentrated in any 1-2 sectors, and not panic in a pullback. That would just be a temporary emptying of the storm water from the lake of returns, nothing else. I would like to emphasize that this is just an expert opinion and not an investment advice. So that's it for this video, guys. Make sure to smash the like button and subscribe if you haven't already.